And I'll just check that it's going live in the group as well. Okay, wonderful. We are live in the group also.
Hello, Internet.
Yeah. Sorry?
I just said hello to the Internet.
Oh, yes. Yeah. So that's start. Welcome, Luke. Very happy to have you. Yeah, you are the founder of Microburbs, right?
That's right, I am. Yes, your video has gone. Is that intended? So I can only hear you.
Yes, you are the main talks. So I just let you appear. Yeah, I just support on the side.
Yep, I won't take my video off. Don't you worry.
That's good. That's good. Yeah. Yes, because I've been using your program, the Microburbs, the member one. Yeah, I find it very helpful. It's quite detailed, very interesting. Yeah, so I know you are a data specialist also. Yeah, so my group would like to possibly, ask you some question and learn some more knowledge from you today.
Yeah, happy to be out there speaking to the Chinese community.
Yeah, wonderful, wonderful. Thank you. Yeah, so maybe I let you take it away, and yeah, you can also answer some of our members' questions that I provide to you before.
Okay, so do you want an intro on me or Microburbs?
Yes.
Yeah, so Microburbs is a real estate site that I created in 2014, and it's all about breadth of coverage. So we cover livability, but we also have really in deep back-tested capital growth forecasting. We go hyper local, so we go down to the street level and increasingly the property level. My background is as a data scientist, so I'm very much about analyzing things from first principles, doing primary research to find what are the drivers of capital growth in particular. So it's a whole lot of context about places, HIP scores and family scores. So there's the soft side of things to provide a real sense of the communities down to a pocket level, but it's also a whole lot of very rigorous, hard numbers, good analysis to let you know where that property is going to be in a few years' time. Lillian.
Yes, wonderful. Yeah, I think in the questions I collected previously, yeah, one of them is related to, like I know statistics and all this is very in depth, but how to say how closely does it follow reality, like as it unfolds? Yeah, I'm just curious.
Yeah. So the more data the machine has on something, the better it is at forecasting it. So as you go down to a property level and as you go over a long period of time, it becomes ever more reliable. So computers are counting machines and they use statistics. And if you give it a whole lot of different data over a large amount of time, over a large amount of geography, that's how you get to more accuracy. Whereas if it's a short amount of time and a small number of locations, so for example, often in the real estate industry, they'll name a couple of example suburbs to try and prove some point at particular points in time. So that's not the kind of analysis that we do. So we're all about collecting as much data as fine-grained as possible to see, does this really drive capital growth in a universal way, or is it something else? Is it something complex? Because very often these trends go into reverse. It's very normal in the real estate game that, regional or big backyards or whatever, they're popular for a couple of years and then it swings back. So what are my job is all about identifying what you could call more like the laws of the real estate game, as opposed to coming up with narratives about, that work in the current market.
Yes. Okay. You mentioned some rules. So in your career of analyzing data, what are some obvious rules or trends about property market that you have noticed?
Excuse me. Yeah, so the biggest insight is that it behaves in a similar way to the stock market. So you have what's called mean reversion. So that is that markets get really hot and then they come back. So in the same way, it happens with companies as well over shorter periods of time. There's all this excitement and momentum. It goes up for a while and then it springs back. So that is the most universal law of real estate, is that it's an imperfect market. So you can have a whole lot of buyers in one market and a whole lot of sellers in another, but then it can switch over. So you can very often have suburbs that are overvalued and then undervalued. And it's not a simple market clock. So markets can last different lengths, and there's a whole lot of complexity about analyzing this, which is definitely much better done by machine learning, because it can actually look at billions and billions of graphs, whereas no human can take in that amount of information. So that's coming back to that question of where is data most strong. It's things like that, where there's a very large amount of information.
Okay. I think we better jump into some of the questions. What statistics are used to predict future capital growth of a suburb?
Yeah. So mean reversion and momentum are the first two. So I covered mean reversion there. That's just going back. So a boom market crashing and a dud market going back into boom. And then the flip side of that is momentum. And that is like the market continuing to move. So buyers typically overestimate momentum. They think that 10-year growth is a good thing. Usually it's a bad thing. But there is still a thing of momentum. So there is a certain time period where the market is returning. Another thing is yield. So you actually want really good yields. So when the rents get high, relative to the price, then you tend to get more capital growth as well. But you don't want super good yields. So what you want is about the 95th percentile. So you want to be ranked 2 out of 20 markets you could think of. So yield is actually a good thing. You'd think it'd be a trade-off, but it's actually not. Yeah. So another thing is gentrification. So this is sort of a Goldilocks kind of thing. So it can be too high or too low. So you can have areas that are seriously disadvantaged. It's not a simple matter of a single score that anyone has put out yet. We'll be doing another one soon, but we also already have an affluent score that covers this fairly well. So if it's too low, then that can inhibit growth. But also when it's really high, that inhibits growth as well. And in the middle, there is more scope for growth. But when I say the middle, it's very broad. So it includes the working class. It's once you start getting up into the upper middle class that growth can, a lot of the growth you can tend to see at that top end is really just in the building. So people are spending a lot of money on refurbishments, beautiful, Smeg and Mila, and beautiful tubs and things. So that's not really the kind of growth you want as an investor. You want it to be in the land. So I would avoid the top end. And public housing is part of this gentrification picture. So we have quantified exactly how much public housing and how far away. So you don't want it to be close, but you also don't want it to be within a few kilometers, even if there isn't any close. So public housing is something to look out for over a wider area as well. Supply is a bad thing. So again, it's a question of how much and how close. And it's kind of a LGA kind of level. So like a few kilometers, 3 to 7 kilometers. It matters when there's new supply. When you're talking about capital cities, it doesn't matter nearly as much in towns, because new supply can also mean that there's new scope for new amenity. So if you put in another 500 houses, that might mean that the town can support a chemist. It can support a pub. So supply isn't such a big deal in regional centers. It can be a good thing. Turnover rates. So how often a property is turned over? Yeah, that question before about how much can you really cover with data. So a lot of things that are otherwise missing from the data, you can find in turnover rates. So whether it be that there's a landslide issue of the property, there's chronic mold, or you have a neighbor who turns the hose on you, whatever it is, these things can show up in the turnover rates. So the more often an individual property has turned over, has been sold and resold, the less the subsequent capital growth.
Oh, okay, I see. All right.
And that happens on a street level as well. So you don't want streets, you want tightly held streets.
Okay, okay. Oh, interesting points. Great. What are some key info and statistic you think are really important to review before buying an investment property? I mean, you just covered those, right?
Yeah, so I would definitely personally want a really good machine learned forecasting thing. It's not something that can be done manually. So our model, for example, outperforms the market by 7.8% per year. So that's a very large difference. And it's not really like I couldn't do what it does manually. I can't forecast like it does. As much as I've spent supervising it, it's just we've got data going back to 1990. So you just can't, like, the AI is just way better than a human at achieving that. And the model's also designed to be resilient so that when there are shocks, it has to make money. During the GFC and during this current GDP per capita recession, it has to always keep making money. So, and it's back tested, which means that it doesn't know the future. So looking at different points in time, it only can learn from the past, makes a forecast, and then it gets judged on how well it goes with that forecast. So, so like a stock market trading algorithm.
Okay, great. When a suburb has lower income median, does it mean the suburb will grow in value slower? So you just cover that, right? Like not too low and not too high. Somewhere in the middle is better for growth, correct?
It's not primarily income that has shown up as. So what we do is we throw in everything. We've got thousands and thousands, tens of thousands of indicators. We throw them all in there, and then we find what correlates, but also B, controlling for other factors, what are the really useful ones. And we don't use income. We do report on income if it's interesting to you, like you might have your own theories. There's a whole lot of data that we provide to the investor because they want to know. But the income, and in terms of demographics, working class is totally fine. So even, there can be some fighting down the pub. It's totally fine. So when I say low, I'm talking about more certain kinds of welfare dependency.
Okay, I see. Oh, so that's like too much proportion of welfare dependency is not good for that suburb.
That's right.
I see. Okay, interesting. I'm just curious, what's your personal favorite forecast of best performing cities, metro and regional area or suburbs? You wouldn't mind tell us?
Yeah, so I don't have any personal emotional connection to these things. So I hear a lot of pundits out there.
Tells us.
So a lot of the pundits, they will be saying how they're really attached to Hobart. I'm really behind Hobart. I think it's great. And they'll go on podcasts and talk endlessly about why they think it's got great fundamentals and all this. I haven't got into that kind of market punditry kind of thing. So a big thing is we're very much about the micro. So I'm not like a macro economist. I don't have a view on what's going to happen in Ukraine or, the US election or the RBA's interest rates. My focus is on capital growth relative to other markets, not the overall macro thing. So we don't even look at state level, like gross state product thing. I mean, obviously it is important, but I would caution anyone who's listening to a pundit predicting on a city or a state level, just make sure you know what their track record is, because it is quite a hard thing to do forecasts using spreadsheets, using small amounts of information. But what I can tell you is what our model is, what areas of the country our model has found particularly good suburbs. So out of our top 20, for the top 20, regional Queensland has 9. So outside Brisbane, 9 of the 20 regional Queensland. And then there is in WA, there's 4 in Perth and 4 outside Perth. So that's looking fairly good. Melbourne has 2, and there is 1 in South Australia. That's outside. That's outside Adelaide.
Okay, so currently, nothing in Perth is on the top. Hobart. Nothing in Hobart is in the top 20 at the moment.
Nothing in Hobart. Nothing in Sydney. Yeah.
Okay, got it. That's
nothing
fine.
Nothing in Brisbane.
Okay, yeah, interesting. Why nothing in Brisbane? Like, is it because the price has already grown so much? So
that's the basis of the model. Yeah. So the model is very focused on relative prices. And it's not always talking about the overall. So it's not necessarily a macro view. It's more that there aren't great mispricing opportunities within Brisbane. So what this is saying is that overall, Brisbane is relatively well priced. There aren't these outliers where there's a massive opportunity for getting more growth.
Okay, so you say you look at a more micro environment. So I guess are you saying in every major cities you should still be able to find particular suburbs that are still doing well? Is that how you identify, or?
Yeah, my approach is very much like where out of the whole country. So this is specifically for the capital growth forecasting backtested algorithm. We have other things that aren't this, but it's very much about pricing and volume and all these other real estate market-y kind of metrics. The approach is very much just like which suburb for the whole country. In the same way, if you were a stock market trader, you had an AI, it would just be looking at a whole lot of curves. And it doesn't care whether it's in mining or tech, maybe. It's just looking at the curves. So these kind of algorithms actually do most of the trades on the stock market. We're a long way from doing that in real estate. But so it is really just a reflection of mispriced things within the particular suburb. I did have some of our models that do have macro predictability. So the model that we were using a couple of months ago, I actually ran that and found that it was predictive of regional. So capital city versus regional for each state. And I found that it was outperforming the market by 3.2%. So that was like a bit less
regional.
than
regional.
Yeah,
is
even though no, as in dividing the market up into Sydney, regional New South Wales, Brisbane, regional Queensland, Melbourne, regional Victoria, etc. So at that level, so just by putting together, getting an average of all the forecasts and then seeing how well that performed back to 2005, I found that it actually was predictive. But other models I built don't. So it's not, from what I've found, it's not necessary to know the overall city momentum to get these kinds of very high capital growth. It's much more about mispriced suburbs. Wherever they happen to be.
Okay. Mispriced suburbs. So does that mean suburbs that is still much more affordable compared to nearby suburbs?
That's right. Yeah, they're too cheap compared. So that one is that they have been too low for too long, and the other is that they have they're cheap relative to. This is oversimplifying it. There's more going on, but you can think of it as relative to similar suburbs. It has fallen back.
Okay, understand. I think I have a few macro questions. What do you think of Melbourne and Sydney? Like, what's gonna happen in the future? Because lots of people are complaining it's becoming overpriced, and yeah, they are moving to other more lower price states. Yeah, although Perth and Brisbane has gone up a lot, it's still like compared to Melbourne and Sydney, it's still more affordable. So I don't know. Sorry to ask you another macro question, but yeah, what's your view on Sydney and Melbourne?
Yeah, so Sydney and Melbourne have lots of migrants, and often migrant suburbs do better. So migrants tend to prioritize things like convenience, access to work, their own amenities for their own communities. So
Yes.
That's a plus for Sydney and Melbourne. Capital cities in general outperform. So I'm taking this very long-term view. So I'm not talking about like today in 2024, is it now too expensive for this kind of person to stay in Sydney? Just taking my thing is more about like what's something that I can prove ongoing rather than and other people's analysis might be like, yeah, what's the breaking point for Sydney? What's the point where this kind of person can no longer handle it, and they talk to these people and then they go out to regional Australia, and it's a good story. I don't know on that level, but yeah. So I think Sydney and Melbourne are, so as you get closer to the CBD, there tends to be less volatility. So there's less downside risk in general closer to a CBD.
Okay, sure.
And they're obviously both very diverse markets. So Perth being more mining based means that the downside risk is reduced.
Sorry, I didn't quite follow the last one. If Perth is a mining town, why is the downside risk like more associated with mining? Why is the downside risk reduced? Can you?
So two things. Mining towns in general are really bad news. So you don't want miners living in your town if you want capital growth. And then secondly, Sydney and Melbourne just represent very diverse economies with lots of different industries. And that kind of industry diversity means that there's always going to be a different kind of person who wants to come in. Yeah. So they've got lots of schools, they need teachers to come in. Maybe that's not the best example because everywhere needs schools, but they have lots of finance, so you can bring in finance people, and then fintech or some other industry, insurance or whatever, right? They will come in and replace the people that are there. There's obviously stature, so those sort of things help keep the market up in these major capitals.
Oh, okay. So so because Melbourne and Sydney have very diverse economy, this is a strong point for them. It's always going to be the strong points. Okay, great.
Yeah,
good to know.
Of course, it does make sense, the flight to affordability as well, though, obviously. So we're a very supply constrained market, and it is expensive. So there's definitely logic to this idea that it gets too dear. Obviously, that's like a law of real estate. You can only pay what you can afford, right?
Yes. Okay. Let me see. Yeah, I just wondering, there's a lot of property research tools out there. What do you think is the strong points or the difference compared to Microburbs? Yeah, I just wondering.
Yeah, so at Microburbs, we differentiate ourselves in having the most diverse database. So we look at the most different stuff: gentrification, livability, amenity. Other portals will be more just like real estate market focused. So it's very broad. We have this expert interface that most investors don't need, but it's there if you want it. Like if you want to look up something very specific, and there's like 10,000 variables on there. even more importantly is that we've used those to do a big scan to find what are the most important ones and build them into our models. So
Yes.
a big difference is that I'm the founder, I'm a data scientist, AI machine learning guy, been doing this for a very long time. And that's the base culture of the business, is learning and just being objective about what actually achieves the outcomes. So being primarily data driven. I think a lot of the other sites are more, they're good interfaces, and they're more like IT people that have built an IT product that serves the customer. So we're more hyper local. We go down to the street level. So you can get street level turnover rates. You can get noise maps that go very local, and heat maps for price. For example, we're well known for public housing and HIP scores. So it's more of a broad picture that we're painting, as opposed to straight data. Obviously, comparing us to the biggest people, so CoreLogic, realestate.com.au, and Domain, their customer is the real estate agent. So that's very different. That affects the way that they talk about prices and the kinds of information, the limitations on the information they want to provide because of who pays them. We're paid by the buyer, and we don't mind which property you buy, and we don't even mind how long it takes you to buy. So that's a difference in the way that our products are structured. So it's like, we'll just help you find wherever. I'm not emotionally attached. You don't have to buy Hobart. It's just all we care about is the predictive accuracy of our models.
Interesting point. Yes. Yeah, I find after I use it, it's very addictive. Yeah, because it's very comprehensive. Yeah, it does help you to you feel closer. You seem to feel like you understand that particular suburb even more. Yeah, with Microburbs. So I really enjoy it. Yeah.
Glad to hear.
Okay. Yes. Finally, I just want to inquire, like, can you share any more other helpful insights, knowledge, that you gain, in many years of, doing data research, with us?
Let me think. So one predictor that I hadn't mentioned was geography. So coastal places tend to do better. Beautiful places, we're going to have more to say about this soon. It's only certain kinds, but that's a good long-term predictor of capital growth. Excuse me.
Right. Okay. Yeah, I'm aware that you are not feeling well today, Luke. So thank you very much. Any final words you would like to add before you go?
No, just if you're interested, go to www.microburbs.com.au, and everything on the site you can sign up for free and have a play. And by paying, you just get access to even more data, but you can see how the whole system works, get familiar, get free samples of things before you go ahead and pay.
Okay, wonderful. Thank you so much to have you today.
Thank you very much for the opportunity, Lillian.
You're welcome. Yeah, take care. Recover soon. Have a good
Thank
night.
You.
Bye-bye.
Cheers. Bye.